Do you need a plan to beat the tax man, especially when you retire? I'm Tracy Capelman. How to avoid tax traps and have more money when you need it, right now on Your Wealth Health. Hello and welcome to Your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman. Now, we continue with our series of shows designed to help you develop a tax plan to beat the tax man in retirement. We're explaining how you can keep much more of your hard-earned money if you have a comprehensive tax strategy. Now, I'm here with founder and CEO of Hilltop Wealth Solutions, Eric Brenner. And Eric, when we talk about tax planning, we're really talking about tax saving, especially in retirement, aren't we?
Yeah, we really are. We say more people plan longer for their vacation than they do their retirement and during their retirement. And so how I think about it, Tracy, is that, people have this period of time, they're climbing their mountain, they're saving, investing, and so forth. And they get to the top and on the way down, that's really tax planning, forward-looking tax planning during retirement.
And you know what? I think you're right. I think that quote was awesome, that you spend more time planning your vacation. I think we all think we're going to have more time. Like, it just feels so far down the road,
Yeah, that's absolutely true. And one of the things that we have is we've got what we call kind of 4 stages of retirement. The first stage is kind of that pre-retirement. If it's 50 to 60, people are kind of getting kids out of school and out of their house, hopefully. They're continuing to work and they're really starting to think about retirement. Then you've got early retirement. That's kind of that 60 to 70. A lot of people retire during that period, and they're moving, they're traveling, they're really doing a lot of things. Then you got the middle retirement, which is kind of the 70 to 80, and they're still going, but they're slowing down a bit. And then finally, late retirement, and they've enjoyed life hopefully, and they're now thinking about making sure that they pass it on to the ones that they love.
Absolutely. And this week we really wanted to focus on 2 of the most critical components of everybody's retirement plan: Social Security and Medicare. People don't realize that both have tax traps that they really need to be aware of, don't they?
Yeah, they do. And, I'd like to start off with kind of the retirement surprises that come into play. One is inflation. Think about just a few years ago what it cost for a gallon of gas and, other things that you purchase. Longevity, Tracy, this is a big thing. Longevity, people are living longer. Their expenses, what are they going to spend during their retirement years? And finally, healthcare. That's another big thing. So recently I watched the show, The Good, the Bad, and the Ugly. And I wanted to talk about that with Social Security. The first graphic there is that, Social Security is calculated after the highest 35 years of earnings, and earnings after 62 can still increase Social Security benefits if they replace those 0 or low earning years. So oftentimes people don't realize that you may be able to work even after 62 and replace some of those 0 earning years. The next one's the bad. If you take Social Security early, you're penalized. So it could reduce your benefit. And in fact, if you're continuing to work, your benefit gets withheld $1 for every $2 that you earn over $18,960. So that gets held and then added back to your benefit calculation upon full retirement. So I highly recommend, if someone's going to draw Social Security and continue to work, they need to make sure that they're doing that and that they've got some good advice on doing that. And then lastly is the ugly. You pay Social Security tax even when you work in retirement. And so even when you're receiving benefits and working, and again, the benefit only increases if it's one of your top 35 years of earnings.
Wow, some great information there. Now healthcare is, of course, a huge expense for all of us. And in retirement, it's perhaps the most critical concern. But again, tax traps to consider, right?
Yeah, that's for sure. The example I have here on the graphic is this, what we call Medicare Irma Tax, okay, which stands for Income Related Modified Adjustment Amount. So the example here would be George and Martha. They have Medicare Parts B and D, and their modified adjusted gross income was a little over 275,000 for 2019. Now, what they do with Medicare is they go back 2 years and see what your income was at that time, and that determines if you will hit this Irma cliff. Well, in this example, you'll see that they sell a stock for $1,000 gain, and they owe $188 of tax. So most people would think $1,000 of gain, 15% long-term capital gain rate, and there's a surcharge that they're going to pay of 3.8% because of their income. That means they'll pay 18.8%. Well, that's not really the case, Tracy. So people have to be aware that Irma, there's what's called a cliff. So you'll see a graphic there that shows if someone goes from 276 to 276,001, that now puts them into a higher premium amount for their Medicare, which totals between the two of them about $180 a month. So
Wow.
plus then, Tracy, you have Part D. So not only did it bump them up for Part B of Medicare, but Part D, which totals about $39 a month. Now, if you look at the graphic, then totally what's happened is they now get an increase on their Part D, B, increase in their Part D, okay, for both. That's combined of $2,604. So really, you look at this and see that just that sale of a stock of gain of $1,000 now caused $2,604 additional for this example. So mistakes get very costly from a tax standpoint when people make these decisions.
And this is why you need a professional. Man, I'll tell you, that was a great example. Eric, there are so many considerations when it comes to saving money through a good tax strategy. And I understand that Hilltop wants to give away a new book by one of this country's leading experts on tax strategy and planning, Ed Slott. And the book is called The New Retirement Savings Time Bomb. Now, it is described as a complete action plan, if you will, to help you make sure your 401ks, IRAs, and retirement savings aren't depleted by taxes by the time you need them. Robert Powell of USA Today and Retirement Daily had this to say about it. The insights you will gain from reading this book will be invaluable. Eric, tell us a little bit more about this offer.
Well, Ed Slott, we've been affiliated with Ed Slott for quite some time, and he really is one of the nation's leading experts. You may have seen him on TV or read one of his other books. And he is a CPA, and he really focuses on educating consumers and educating advisors on those tax bombs, those strategies that could get you in trouble when you get into your retirement years if you don't know that they're coming.
And Eric, Hilltop has a special relationship with Ed. All of our advisors, correct, are members of his elite advisor group. Explain why that's so important.
Yeah, we are. And really, what the elite advisor group is, Tracy, is there's about 400 of us around the country that we apply to be part of this group. And then we must do continuing education, many hours a year, to make sure that we're continuing to stay update on all the tax laws, tax strategies, and tax changes. So, I take this as pretty important when you think about around the country that there's about 300,000 financial advisors, and 400 out of those 300,000 are part of this elite group. And so we spend a lot of money as a firm just to educate our advisors to make sure that we're really giving the best advice to people. And, Ed Slott and his team of advisors, which consist of attorneys and CPAs, are there to help us and really be a sounding board as we work with clients.
Oh, that's awesome. Well, the author of that book, Ed Slott, is also one of the leading experts on Roth IRAs, and he feels strongly that now is the time for many people to convert their traditional IRAs to Roth IRAs. And that issue will be one of the subjects we're going to focus on during our next show, correct?
Yeah, that will be one of the topics today. With right now, I say this a lot on the show, but we're in 40-year tax lows. And so, now is the time to really think about determining what your forward-looking tax plan look like.
And also next week, how to spend your income wisely during retirement. What accounts should you spend first when considering the tax implications? So join us next week. For this week, we're now out of time. For Eric Brenner and the entire Hilltop staff, I'm Tracy Capelman. Thanks for watching and stay wealthy. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.